Sorry about that. Got the Patriots playing in the Super Bowl later. And welcome, Fed watching for the week of January 28th through February 1st. And what an eventful week it was. Another little up week for the market. Let's get right into it. It's Monday, January 28th. And we got a little bit of a down day, down about 1%, pretty much across the board, as we got some weak earnings numbers. We got Starbucks guy says he wants to run for president. We got people talking about Nvidia, people talking about Caterpillar. Those were some of the weak guidances. And later this week, we actually got a couple of interesting things. We got a GDP number that's going to be coming, and it might be late. So what I'm still seeing is it's not certain if we're going to get it on time because of the shutdown, even though we're reopened up. It takes time to put it together. But what we are going to get is an FOMC meeting. They could change the rate now. I don't think there's any way they would raise it. They could lower rates. I think that's pretty unlikely too. But it's on the table. So we'll see what they say. Market will probably react to whatever they say one way or another. It's Wednesday. You heard right. No Tuesday. Missed yesterday, recording some pods, doing a little work on the back end. Boring day anyway. Not much news, not much happened. Stock's down just a little bit. Got everything back today. Big day. The Fed said basically nothing. If you're a listener of this pod, you know that the Fed has said they're going to be very slow with their rate hikes. The Fed said we're not doing a rate hike and we're going to be very patient. And the market said, holy shit, really? We'll go up on that news. And we got a little 1.5%, 2% day. So nice return. Dow's over 25,000 in case you're into that kind of thing. And we'll see what the rest of the week brings. The earnings come out strong. We'll keep going up. Earnings come out weak. Probably give it all back. It's Thursday. Strong earnings. Market up about 1%, except for the Dow, which is actually down just a smidge, but down. And this is where the Dow having so few components kind of rears its head, where if 10 of the 30 stocks move in a weird direction that would be unexpected, the Dow does something unusual. But by and large, S&P 500 up almost 1%, NASDAQ up over 1%, Russell 2000 up almost 1%. So big Thursday. We'll see how tomorrow is and see what kind of week we end up with. But seems like a decent one. It's Friday. End the week with a little bit of a mixed day. Dow up about a quarter of a point, S&P 500 up a tenth of a point, NASDAQ down a quarter, Russell 2000 up about 2/10. So basically flat, not much. Really, really strong jobs number, payroll number, over 300,000. And unemployment actually ticked up a bit, which is part of that trend that we've been talking about, where more and more people are entering the workforce. People that previously weren't being counted are now being counted. So a lot of jobs are being created and people are coming out of not seeking employment to fill those jobs. So that's a pretty good sign. That's a pretty good thing to see. Once again, up week, everything up between 1% and 2%. Larger international EFI, you see up there, just under 1%. Everything else way up. 10-year treasuries down. These things are related. The Fed came out very dovish, exactly where they had been, actually, which is surprising to me that it was a little bit of a surprise to people. But they came out and said, we're going to be very patient. We're not going to raise rates unless we see a really good reason to. And the market liked it. We already touched on the big economic points during the dailies. The Fed came out, did not raise rates. They could have. And remember, this year, they could raise rates. They can always raise rates anytime they want, but they're going to have 8 meetings where it's reasonable to expect them to move rates versus just 4, the way that they previously used to do it, because they didn't have press conferences 8 times a year. They only had them 4 times a year. And they're always, unless there's an emergency session, going to couple a rate increase with a press conference so they can explain the rate increase, because otherwise it won't have the intended effect, or it might not. Huge new jobs number. We're still waiting on some of the related numbers, and wage growth wasn't that high, but the jobs number was huge. People joining the workforce was huge. Those are both big positives. The Fed, part of its statement, was something everyone's been talking about, which is balance sheet normalization aka quantitative tightening, aka the opposite of quantitative easing. If this isn't your area of interest, if those are all Greek to you, then you can just ignore it. But if that is something that you think about a lot, this is what we should have been expecting for a while. Them to say we may not just let the balance sheet normalize on its own. We're definitely willing to slow it down. And that's exactly what they said. They're willing to keep everything on the table. They may make the normalization take a little bit longer than it would if they just let all of the holdings mature. And that's exactly what you'd expect from a dovish, very easy money type of statement out of the Fed. I'm going to try something new. I'm going to replace the link segment with a segment that I'm just going to call Jack Talks. And this is where I will talk to you about something that I think is interesting or something that's out there and let you know what I think about it. So this time, let's talk about Elizabeth Warren's wealth tax proposal. Now, it may or may not be constitutional. I'm not even going to touch on that. Obviously, if it's unconstitutional, then basically dead in the water. But what I want to talk about is people are definitely underestimating how easy it's going to be to make this thing happen. Let's say it gets passed. It's very popular. Everyone wants to do it. I may get some of the details wrong, but broadly speaking, it's a tax of 2% a year on assets over $50 million and 3% a year on assets over $1 billion. Now, what you may not realize is it's actually very hard to measure people's net worth when it's that high. The only time that it's easy is when it's in liquid, publicly traded stuff like how much Amazon or Microsoft does Jeff Bezos or Bill Gates own. Then you can calculate it. But you get into a whole bunch of weird situations there where you're taxing the stock, they have to sell it to pay the tax, and then it generates income tax. It might have a bunch of weird knock-on effects. But not even talking about them. Most people with more than $50 million have a lot of things that are very hard to value. Real estate investments are very hard to value. Companies, closely held companies, extremely hard to value. It'd be very hard to be fair. You'd have to get an audit. Audits are long, expensive, hard to do. Who would pay for that? Are you going to tell them they have to pay for it every year? That 2% tax could pretty quickly become a significantly bigger one. And people are going to find ways to game that. If this gets passed the way it is, this is basically the accountants, attorneys, and other financial advisors full employment bill. If that's what you're going to do, I mean, you're going to find different ways to take dollars that are very easy to measure and reinvest them in ways that are harder to measure. Any man is allowed to arrange his affairs as to minimize the tax that he owes. So that's what people are going to do. I can't imagine. I think there's over 80,000 people that this would affect. Every single one of these would have to get audited every single year. It seems to me like a much cleaner way to do the same thing, and probably a much more popular way, would just be to make the estate tax apply to way more people, and maybe not exempt charities or foundations from it. I mean, that would be the big change that you have to make, is you have to not let people give all their wealth to a foundation before they die. But if you really wanted to get something like this done, instead of doing it literally every single year, you just do it once when the person dies, and you don't let them disperse that money to all of their relatives or to the charities that they prefer. I think that's the only way that something like this ever really gets traction, once people start looking at just how onerous it would be to make this happen. I think they would have to hire thousands of people at the IRS. And do they have the training to do it? Would it be fair? Would it, I think they'd be a little bit outgunned as far as figuring out the best way to measure this. It would be a very, very difficult task. I doubt it would raise the kind of revenue they expect. That's it for this time. Thanks for tuning in. Go Patriots.